Okay, we talk. Okay, this week my suggestion for you to listen is Morgan Housel podcast. He's doing this for last 5 weeks, and they are very interesting. I would recommend if you are um, if you want to. Mm, I mean, this is one of he's the same guy who wrote Psychology of Money, the book, famous book. It became quite famous since it's published December 2020, and it's one of the bestsellers in the finance section. It's called Psychology of Money, and the same author he also writes blogs, which share in the group time to time, and he also has podcast. Interesting about this guy is whenever he's telling some idea, he always tells with a historical example, real example. That way the ideas stick for a long time if you listen to him. So he's a very good storyteller in the finance world, and he connects the ideas from different world, not from the finance world. He connects the idea from different worlds and bring back those ideas to finance to understand how we behave and do things in the finance. So that's this week recommendation, Morgan Housel podcast. I'm sure you must have iPhones, so you can easily subscribe to his podcast in podcast app, and then whenever you are biking or traveling, try to just listen in so that you understand. You get a benefit of understanding some ideas. Okay, so we started talking about intrinsic value of the business. So I would say we reached to a milestone now. We know the financial numbers. We looked at the income statement, balance sheet, and cash flow statements. We also derived some numbers, return on equity, return on invested capital, price to earnings, free cash flow. So now it's time to calculate the value of the business. So intrinsic value is nothing but it's a fancy term. It's a value of the business. How much value you want to pay for a given business if it is been offered for you to buy it, right? That's the intrinsic value. It's not what a market is quoting. That's totally different. So whatever market is quoting in the share market, that's different than the actual intrinsic value. So this graph tells you. So um, this blue line is the market price. Sometimes it's overvalued, sometimes it's undervalued or underpriced, and then it overvalued. But intrinsic value of the business is a constant. It doesn't change based on the market participants, because participants changes the price of the business. It can be overvalued sometimes, can be undervalued sometimes. So that's what we are doing now. So the reason I'm saying this is a milestone, after this we should able to pick up any business in the world, and we should able to calculate what is the value of that business. I want you to reach this level so that you would understand, is this business selling for the overvalue or undervalue. So this would help you to make a decision whether you should buy a business or you should pass on the business. So that's the goal of calculating the intrinsic value of the business. And the method we are using, there are multiple methods through which you can calculate the value of the business. The method we are using is DCF. This is the method Warren Buffett and many of the big investors recommended for valuing the business. Hence, we are using the same method so that you can add this into your toolbox when you want to calculate the value of the business, right? So we can hear from Warren directly. He's been explaining this for many times. So let's.
Hello, Mr. Buffett. I got two short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments. It says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about 110 to 15 billion dollars in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you instead. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock.
That's very important. I see many of my friends or people around me, they're buying stocks without even knowing what is intrinsic value, and they doesn't have a clue about how to calculate intrinsic value. So I don't want you to be in that situation. So you need to learn what is how to calculate the value of the business. That's also what Warren and many people recommend or suggest you. Yeah, uh, there is a sidetrack I can tell you here. Investing became so easy for many people these days because anybody can open brokerage account and start putting money into stock market. It became so easy, and anybody who knows, who has some money, then they are going and investing without understanding the basics of investing. That's the problem I see all around me. They doesn't know the basics, but they want to go and invest their money. That's also why I'm doing this session, so you learn these skills. So if you are sick, you would go to the doctor, right? He has to be a professionally trained doctor. You don't go to anybody in the street to treat your disease. Similarly, investing, you can't just go and invest without learning the skill. Yeah. So that's the message, right? So you should put some effort, understand the logic, understand the ideas before you start parking your money. Of course, you may not be perfect from the day one. That's the game. At least you should know the basics. You should know the concepts before you start parking money. I know many of my friends, including me, at the early stage of investing, I used to invest without even calculating the intrinsic value or the value, what is the actual value of the business. But over the time, I rectified my errors and try to avoid them. So you should also do the same. You should know how to value the business. That's what we are going to learn today.
You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Number two.
So you got
So basically, Warren is talking about DCF method, how he uses this method to calculate the value of the business, and I think yeah, this if you see the formula for a discounted cash flow method is simple. You can see it on the screen. Cash flow divided by um, 1 plus r rate of return to the power of t. To the power of t means it's time, you know. So let me take the whiteboard. Okay, so we want to value the business, right? So we understand from financial statements. So we have P&L or income statement. This is income statement, and then we have balance sheet. Then we have cash flow statements. Okay, so from the cash flow statement, we can calculate the free cash flow. This is the free cash flow. So the free cash flow formula we discussed a few sessions ago. Free cash flow, basically cash flow from operations subtracted by capex. So capital expenditure, whatever the capital expenditure that business required to run the business, if you subtract that from the cash flow from operations, you get the free cash flow. So what we are doing is we are taking this free cash flow number. So if you see a DCF formula, as we saw some time ago, it's a cash flow. That's nothing but free cash flow here, which we are getting it from cash flow statements, right? Divided by 1 plus, this is our rate of return. Which rate of return uh, you want to power of t. This is the formula which we would be converting into Excel sheet to calculate this. So I just want to show you this free cash flow. You can get it from Ticker. This is the site we are using, or Screener. These are the two sites we are been using. So this is the number. You can get it from Ticker. I'll show you how to get this number. So I'm just trying to explain you how can you get the different numbers in order to calculate the value of the business, right? So this is a summation. Do you know what is summation? 1 to, let's say we will do for 10 years. So we are, so equal to 1 to 10 free cash flow divided by 1 plus r to the power of t. is the time. T equal to time, R equal to rate of return, and free cash flow. Yeah, this is free cash flow. So when I say I to 10 means this is for 10 iterations. So we say free cash flow for year 1 divided by 1 plus R to the power of year 1. Okay, plus for year 2 free cash flow for year 2 divided by 1 plus R for year 2, plus free cash flow for year 3 divided by 1 plus R to the power of 3, so and so up to 10 years. I guess you must have learned this from school maths, right? It's called limits. So you basically limiting the uh, value for 10 years, a formula for 10 years from 1 to 10, you substitute with 1. So this is I, basically I equal to 1 to 10. So for year 1, year 2, year 3, so and so up to year 10. Okay, so basically what we are doing here is we are taking the free cash flow and we are projecting the free cash flow for next 10 years. Year 1, year 2, year 3, year 4 up to year 10. So this is a free cash flow. Free cash flow. This is for year 1, year 2, free cash flow for year 3, free cash flow for year 4, so and so free cash flow for year 10. Okay. So this free cash flow, we are discounting that free cash flow. We are bringing that value to present value at some rate of return. R is rate of return. So you see here in the formula, we are using rate of return, and that's the uh, cash flows of the business, free cash flows of the business. Plus, we want to sell this business after 10 years. Let's assume we want to sell this business after 10 years. That's called terminal value. Terminal value is nothing but you want to sell the business at a given value at the end of the year. So you will also add that to your cash flows. So free cash flows for 10 years plus terminal value. Terminal value will give you the intrinsic value of the business. Intrinsic value of the business. So you are basically calculating the free cash flow for next 10 years plus the terminal value at which you want to sell the business after 10 years and discounting that value to the present value to find out the free cash flow. I can give you the Excel formula, but you need to understand the logic. Hence, I am explaining this from using the formula and then using, all these explanations. Does this make sense? Do you have any questions? No? Okay. So let me go back to Excel sheet. I'll show you. So I did already calculated for some businesses, which I want to show you here. Okay. So here, this is the time, or I would say years, right? This is year 0, year 1, year 2, year 2, year 3. So this is 10 years. So this is 10 years. So let me mark them bit. Yeah, this is years. And you can also see the year 2022. I make this as a base year. That's a year 0. Then year 23, 24, 25, 26, so on, so up to 10 years. And then at the 10th year, I want to sell the business. Okay. That's the terminal value. You see here, we calculate the terminal value, and then here I'm basically doing the discount of the future cash flows and the terminal value. And if you add that all together, if you add all these numbers, you get the intrinsic value. Basically, if you remember the whiteboard I just explained, you take the future cash flows and you discount back. So this is the discount I'm doing. So you're discounting the future cash flows to the present value, and then you add up all those future discounted present value numbers, then you get the intrinsic value. So this is all in billions. So I'll tell you line by line now. So now I'm looking at Google. So I want to know the free cash flow number for Google. Okay. So what I'll do, I go to ticker. So I search with Google. Okay. So ticker is already doing this work for us. We don't need to do this manually, going to the annual reports, calculate the numbers. We don't need to do this because now we have these tools through which it will already calculates the number. So under Google, if you search um, under ticker, you search with a Google name, then you go to financials and then cash flows. So free cash flow is the number we get it from the cash flow statement. So I selected the cash flow, and you need to go down and you see here the free cash flow. Okay. So for Google, the free cash flow for this is last 12 months. For 2022, free cash flow was $60 billion. 2021, it was $67 billion. Okay. And 2020, it was $42 billion. Then you may ask, hey, Hari uncle, for 2022, it was $60 billion, but in Excel sheet, I see you calculated $50 billion. Why are you taking 10 billions less? 10 billions is a lot of amount. Why are you taking 10 billions less? The reason being, if you see, last 3 years, Google free cash flow has gone up due to COVID. During the COVID, many people were at home and using computer or Google services, hence they able to generate a lot of money. But if you see, if you go back some years, in 1919 the free cash flow number was 31 billion. 1918 it was 22 billion. Before COVID it was 30 billion. So I don't want to use this revenue they got it during the COVID, because it will not be the same for the future, right? We don't have COVID every 2 years or every 3 years. It's once in a 100 years event. So Google benefited from it. Hence, I don't want to project $60 billion. So I'm going with a $50 billion projection. That's the reason I took $50 billion for Google. So this is the number I got it from ticker cash flow statement. Okay. So now next interesting thing is you have to project what would be the free cash flow for the Google, right? So here my projection is I expect free cash flows to be increased by 15% every year. It's still so how do I got 15%? You can ask me how are you assuming 15%? If you look at Google free cash flow growth, if you see here, you can also see the free cash flow year on year change. They are been growing 50%. If you see here 50%, then they degrow by 7%, 4%, but then 35%, 38%, 56%. They have been growing free cash flow in 30% above average if you take out this downfall years. But I am being a conservative guy. I am expecting they grow at 15%. All the risks that they are facing with chat GPT and everything, you go in the conservative side, right? So that's the reason, even though they were growing their free cash flow 30% per year, but I took only 15%. I think do you know how to use Excel? So I can show you the formula here. If you go
Yeah.
here, so you are taking the base number and multiply with 1.115. Basically it's 15%. So, and again for 2024 I'm taking 2023 number and multiply with 1.15. So I'm getting 15. So I'm growing this $50 billion at 15% every year. That's the number growth you see here. 2023, $57 billion, 2024, 66 billion, 25, 76 billion, 87 billion, so and so. And 2031, it will be 147 billion. So basically, we are assuming here, that's very important. We are assuming here, Google, though Google is been growing 30%, we are assuming it can only grow from this next year till 2031, 15%. So that's the free cash flows we are projecting. And after 10 years, we expect or we assume we will sell this business. Okay. So what is that we are selling it for? We are selling it for 10th, ninth year, ninth year free cash flow. So if you see the formula, what I used here, I'm multiplying the free cash flow by 15 times. If you see Google, if you look at the same, if you go to ticker, if you go to valuations, if you see market cap to free cash flow, they are been historically selling for 22%, 22 times, 18 times, 18, 16 times, 15 times, 18 times. So again, I'm being a conservative guy. I took 15 times. So I'm assuming in 2032, when I want to sell Google, I should able to sell it to 15 times of free cash flow that it generated in 2031. That's the terminal value. Okay. So these are all the projections we gave for Google. Again, how can you project? You can only project the free cash flows only if you understand the business, and you have to select the business where you are damn sure about the cash it can generate. I can't able to do this projection for Tesla or other car companies because it's a very competitive and many people are but Google in search they have 80% market share, and they are very they I mean they have a competitive advantage. Hence, I'm assuming they would able to generate this free cash flows for next 10 years. Okay. And then in the next step, what I'm doing is I'm discounting here where I'm using this formula which I told you. So if you see cash flow divided by 1 plus r to the power of t. So that's the formula I'm using here in this row. So basically what I'm doing here is I'm taking the free cash flow and discounting back to the present value. So 1 plus, again, I'm using 15%. So in the formula, we have to use the rate of return. I'm using rate of return of 15% to the power of t. So this is the year. So year here, I'm taking 1 because I already have the year values here. So similarly, I used the same formula. So I took the free cash flow for 2024, divide that with rate of return to the power of that year. So if you apply the same formula, you get the present value of the future earnings. So this is the present value. So present value of 2023 free cash flow is 50 billion, though it generates 57 billion. That's the future value. But if you bring that back to present value, it's a 15 billion at 15%. Similarly, even though in 2031, Google may generate $147 billion, but if you want to know what is the present value of that future 140 billion, 47 billion, that would be 41 billion because we are discounting that back to 15% to the power of we are doing it for 9 years because we are doing this for ninth year. Do you follow the logic? Basically, what we are doing is we are bringing back the value of the future money to the present value using the discount method and time. Okay. And similarly, the terminal value that we would be selling it for $545 billion, even though it's a $22 billion in 2032, but the present value of the future money is 545 billion. So now the intrinsic value, basically I did a summation of all the future cash flows plus the terminal value discounted back to the present value. So the present value is based on my calculation with my assumptions. Intrinsic value of Google is 975 billion dollars. This is the bill. It's a value in billion dollars. Okay. So that's the intrinsic value of Google we managed to calculate based on the free cash flow and using the discounted cash flow method, right? So that's and now let's look at how much Google is selling for now. So if you go to Google, if you go to overview, it's selling for 1.3 trillion dollars. You see, it's 1330 billion. So uh, price is 100 and 1300 billion dollars. Is it selling below our intrinsic value or above our intrinsic value? Does this make sense? Is the Google selling for cheaper than what we have calculated, or is it selling for
Selling for more.
more? Yeah, exactly. So we calculated the intrinsic value of Google is 975, but in the market participants valued Google as 1330 billion dollars. So it's more than what so how much more it is selling for? How do we calculate? If I want to know in percentage term, how much more it is selling for? So it's a selling 36% more than my intrinsic value. Would you buy something if you value it's 100 Danish krone, but it is selling for 136 Danish krone? Would you go and buy it?
Yes, because if it's cheaper.
No, it is not cheaper. It's
Oh, you're saying if the value is 100 kroner, but the price is 136.
yes, yes,
Then no.
exactly. So you would not buy it, right? So that's the that's the thinking you have to do when you want to buy companies. You have to look at so this is pure red alert for me. I would not buy Google. I like Google. I love their products. I use it every day. But as an investor, if you ask me to invest in Google at this price, I would say no, because based on my calculation, Google is worth $975 billion, but market is selling it for 1,030 $1.3 trillion. I don't want to buy Google at this price. Nothing against to Google, it just I don't want to pay overprice, 36% more than my intrinsic value. Okay, so let's look at Apple. So I basically use the same formulas for all these companies, and I took the free cash flow. Only variable we have to give input of free cash flow, and then the discount rate. So discount rate I used 15% across the board for all these companies I calculated. And now let's look at Apple. So if I go back to ticker, so where can I find the free cash flow number? So you need to search with Apple and then go to financial statements and then cash flow. Then you look for free cash flow number. You see for 2022, Apple generated $111 billion. Okay. 2021, $92 billion. You can look at the growth. They have been growing 24, about 20%. at least above 18%. Okay. So again, being a conservative guy, I took 100 billion instead of 111 billion. Okay. So if you look at 100 billion and I projected them 15% growth. Again, when you are projecting 15% growth, you really need to do some thinking. Do you think Apple would grow 15% for next 10 years? That's the question you should ask yourself and answer. If it is yes, then you can say that, okay, 15% growth. Okay. I would also tell you, does this make sense or not? Okay. Let's think from Apple point of view. Do you know how many phones Apple have sold so far? They sold around 2 billion phones. So the active connections they have is around 2 billion phones. Okay. And how much is the Earth population?
8 billion.
8 billion. So out of 8 billion, 2 billion, how much is the percentage wise? 25%, right? So they already sold to 25% population. And Apple products are generally expensive. Do you think other 75% people going to buy this Apple product? So you have to do thinking like that. You have to see what is their product, what are they selling. You can do similar thinking for Tesla or any product, any company you are analyzing. How many cars that Tesla has to sell in order to justify your assumption of 15% growth, right? So you have to do that thinking. That's the reason I explained you business model at the beginning before we come to the numbers, because you need to understand the business model of the business before you can even think of looking at the numbers. So once you understand the business model, you will understand what are the key products they are selling, what is the market for those products, how many people they can sell it for, and then you have to project growth and would they able to grow, for the future. But luckily for Apple, they also selling, they are adding additional products, right? Here, earpods and the services they are selling. Every time when you buy a app from Apple App Store, they get a solid 25% money from the app you are buying. So they are also having other services. It's not just iPhone. Now other accessories are contributing to their growth. That's the reason they, even though they are not increasing the 2 billion population where they sold the phones, the 2 billion phones they already sold, under those 2 billion they are trying to sell additional services like earpods, apps that you are using, etc., etc. Does this make sense? You have to do this thinking when you are. So I projected 15% growth for Apple for next 10 years, and the terminal value, again, I am trying to I hope I can sell it Apple 15 times the free cash flow. That's the reason you see M17 times 15. So if you look at the valuation for Apple, if you look at the valuation, market cap to free cash flow, they are always been selling more than 26 times, more than 20. But again, being a conservative guy, I picked up 15 times. So then that comes to $1 trillion. Okay. And now I'm discounting back all those values. I'm discounting back all the future values to the present value at 15%. So that's this row that gives you the discounted value. And if you sum up all those, it comes to 1.9 trillion. It comes to 1.9 trillion dollars. Okay, now look at the present value, present value of Apple. So if I go to ticker overview, you see it's selling for 2609 billion. That's 2.6 trillion. So it's selling for 2609. Okay. Now I want to calculate how much more it is selling for. So you take the, yeah, subtract with your value and divided by the intrinsic value. So it's selling for 34% more than the intrinsic value. Would you buy Apple now at this price? I like Apple, but I would not be buying this at this percentage, at this value, at this price, because based on my calculation, intrinsic value. So let's do reverse engineering, guys. So let's assume how much growth Apple has to make in order to reach 2.6 trillion dollars. So we will simply do some uh, some rough estimates, right? So we estimated 15%, but let's assume 25%. Okay. So I need to bring that 25%. So I added 25% growth. Okay. You see, when I add 26%, 25% growth, intrinsic value of the business changed to 4 trillion. And when the current price is 2.6 trillion. So all of a sudden you feel it's selling cheaper than your intrinsic value. Why do you think you got 4 trillion now? Before it was only 1.6 trillion? Because here I estimated Apple will grow their free cash flow at 25% every year. Remember rule 72. If something growing at 25%, if you use the rule 72, it doubles every 3 years, right? So 72 divided by 25%. So it's almost doubles every 3 years. So that's what you see here. See, after 2 years, third year, it's 200, almost $200 billion. It started with $100 billion. But do you really think Apple will grow at 25% for next 10 years? That's the
No.
question. Yeah, that's the thing you have to do thinking, right? So some people, they overestimate their growth, hence they get the high intrinsic value. So that's the reason. Now, if I bring back to 15%, then yeah, and then yes. So
Uncle,
yep,
isn't it better to estimate at a bit lower value? Because then you can just to be sure, then you know how much it will grow. So minimum.
exactly. That's also what you should do as a conservative effort, because we don't know anything about market economy and all these things. That's when the margin of safety comes into picture. That's the thing. So you should always, even though I'll show you one company which I felt is selling less than all these companies which I calculated is selling more than the intrinsic value. So let's look at Novo Nordisk. Novo Nordisk intrinsic value I calculated. So let's look at Novo. So you can DKK versus USD. Let's use USD, and you go to financials, cash flow statements. Sorry, it's USD here. Okay. So you see free cash flow of 9.6 billion. Okay. So I took 10 billion, 9 billion as a baseline, and then I increased Novo Nordisk at 15% for next 10 years. And the terminal value, I hope I can sell it for 15 times of last year free cash flow. And I discounted back to present value, it's $175 billion. but look at how much Nova is selling today. You see here, it's selling for three $355 billion. I think it's $355 billion. Yes. So my estimate is 175, but Nova is selling for $355 billion. Do you want me to buy Nova Nordisk at this price? Should we buy at this price, or should we say no, thank you, we will wait until the price comes to my value or my range?
I think it's a good idea to buy it.
Okay,
But
then you are, yeah, then you are paying more than 100% than your intrinsic value. Your intrinsic value says it's worth 175 billion, but you are paying for
oh, then you're playing almost double.
exactly. So it's like something you want to buy is worth 175 billion DKK, but it's selling for
Yeah, I
355.
it's because I thought it said 17,000. That's why.
No, the intrinsic value is our estimate. Price is what market is offering us to buy it for. Okay. So yeah, sometimes again, if you go back to the slide here, this blue line, Novo Nordisk, Apple, Google, they are all on the overpriced range now. Sometimes they also comes to underprice. Oh, hurry, uncle, they will never come to underprice. They are very famous companies. People, all the people wants to buy these companies. But if you if you go under that assumption, look at March 2020 or any downturns when you saw market corrected a lot. That time you'll see all these companies selling under price, under the intrinsic value. So that's when you should go and buy it. Until then, you should analyze and keep it under your radar. When it comes to the price you want to pay, then you go and buy it. So basically, you calculate the intrinsic value, look at the blue line, and you say, okay, it's overpriced, I'll pass on. But when it comes to underprice with the 30% margin of safety, you go and buy the business. So that's the logic used by all the great investors. They accumulate cash, they wait until the price is under the intrinsic value, and then they even have 30% discount to the intrinsic value. So basically, if you want to buy uh, if you want to buy Nova, you want to have 30% discount. So it would be 175 times. Okay, so it would be around 17 times 3. So you want to have 175 times 0.30. So you want to buy it for 122 billion dollars. So you wait until it comes to 122 because you want to have 30% discount than your intrinsic value, right? So that's how people use margin of safety to make sure that they still have some buffer. Even though intrinsic value is 175, if you add 30% margin of safety, you want to buy Nova Nordisk only when it is $122 billion. Okay. But let's look at when it was $122 billion. Hari uncle, I don't think you will ever buy a Nova, but I'll show you. If you go to, yeah, overview here. Price chart. Yeah. Okay. So let's look at okay, it shows only the price. Okay, how many shares outstanding? Just let's calculate shares outstanding. It's around 2. Okay. So if you look at here, um, today is 150, right? How much it has to go down if you want to get 120? So you have to. Okay, so I think some point, now I need to divide the share total market cap by the outstanding shares to get the share price. Okay, but then you say, hey, Arey uncle, all the businesses which are great, but they're all selling it for premium price. That means I would never able to get a chance to buy these businesses. Trust me, if you have patience, that's the reason I say all the time, or not only me, everybody, famous investors say, investing is the game you win if you have patience, then the intelligence. If you have high IQ, there is a chance you will lose this game. High IQ would not make you to win this game. It's a emotional game. You have to have control of your emotions, and if you're able to wait, then sometimes market gives you opportunity, then you go and buy them at the discount than your intrinsic value, at least 20 to 30% discount than your intrinsic value. So let me show you one company which I found out is selling less than intrinsic value. So this is called Markel Corporation. It's the same like Berkshire Hathaway. They mm, they mm, they are into insurance operations, but they are also invest into other businesses like Berkshire Hathaway, right? So if you look at Markel Corporation, it's a US based company. And if you look at the financial cash flow statements, if you look at free cash flow, it's $2.4 billion. Okay. So I took, yeah, same to, this is in millions. Okay. It's not billions, it's million, $2,450 million. Okay. And they were been growing sometimes with 66, 42, 30. So I took a conservative 15%. Oh, sorry, even 5%. Okay. So I took a 5% for Markel. Let's assume they grow their cash flow at 5%, or let's assume they grow at 10%. Okay. Not 15%, 10%. Okay. So let me correct the formula now. So I'm converting it to 10%. Okay. And I'm selling it for I'm selling it for 20 times the free cash flow. Okay. And now I'm discounting back to present value. So if I do that, the value I'm getting is intrinsic value is 4.6 billion. Okay. Is it 4.6? Yeah. No, it's not 4.6, 46.33 billion. Yeah. So that's the intrinsic value we got. Okay. So now look at what price it is selling for. So if you go back, it's selling for 17 billion. Yeah,
So that's cheap for the value.
exactly.
So then it's it's a good idea to invest in Markel Corporation.
Yeah, exactly. It's a good um, um, investment, but we took 15%, right? Let's take conservative. Okay, let's take 5%. That's, I think, the reason I was taking 5%. So let's take conservative side. We don't want uh, it to grow 10%. Let's assume they grow 5%. Okay. And even if you do that, it's coming to 33 billion. You see here, 33 billion. And now it's selling for 17 billion. It's almost how much discount you are getting it for? Almost 40% discount. So you have enough margin of safety if you buy this company, right? So does this make sense? I am trying to give you example of overvalued businesses At same time, in
That makes
market,
sense.
you always find some opportunities where, but again, you should not just buy business based on this. This is only one tool that satisfy that justify your decision, but you should also understand the business model. You should also understand what kind of business they are in, would they really grow. But 5% is conservative side. I'm sure we did not estimated overestimated more than 5% is very minimum we expect this business to grow, and then that's what we estimated. So so with that, any questions, anything you want to ask? So from now onwards, when we are doing business analysis, I expect you to do the valuation of the business. We will do exercises in the future where we pick up a business, we do the business model of the business, whichever we picked up, and we try to do the value of the business and see if it is good business to buy it or not. I think you can do this fun exercise for any businesses. Sticker is free for US. You don't need to buy the subscription. You pick up top 10 US companies which you like to analyze and do the same exercise as I showed you here. I'll try to give you Google Sheet, the same
But
version of Google Sheet, so you can copy the formulas and
Priyanka,
well, yeah.
uh, how do you estimate how much the company will grow every year?
Yeah, it's for that you need to understand the business model. So if you look at Google, and another way to do is you look at the
Past.
historical growth, how much
Yeah.
they grown before. Yeah,
So then you can take the average of that maybe.
exactly. You should take the average, but averages also have some flaws. If you look at the market size they are serving, suppose if they are serving a market size of let's say 100 billion, you can't grow your business to 200 billion, right? You have other competitors, everybody else. So you see, it has to be sensible growth. So you need to understand what market they are serving, what is the size of the market. Suppose if you look at the Tesla or any other car company, they have limited market size. Tesla can't sell more than the market size, right? So you should not, your estimate should not go behind the market size of the business model, right? Sometimes some crazy analyst estimates, overestimates the market size. They misunderstand the base value, you know. You need to understand what is the size of the market. You can't grow your business to 200 billion when the market is only $100 billion for that business, right? And you are not the only player. There may be 10 players in that business. So yes, you can look at the past growth to do the estimates for the future, but at the same time, you should also look at the market size of that business, how much market it's serving, how in that market size, what is the share this particular business which you are analyzing has. If it has 10%, then there is a chance if they have a good product, they can grow to 20% market size. Then you estimate, okay, if it is $100 billion, now my company has $10 billion market size, it can grow to $20 billion. So in order to reach to 20 billion, how much it has to grow per year. So that's where it becomes art. Investing is art. It's not a science because you have to do the thinking. You have to use your brain to understand. That's where it becomes fun. This whole business of investing. Okay. So I expect you to play with this sheet, and I'll put this in Google Sheets so you can. I'll try to convert them into nice format so you can plug in the numbers, and then it gives you intrinsic value of the businesses. And you can pick top 10 companies, use sticker. It's free for US, and then you should able to calculate this. Okay. Any other questions?
No.
Oh, thanks for today.
Okay.